Kate, do you have a speaker?
Yeah, we've got Eric Gebhard.
Eric, can you hear me?
Yes, loud and clear.
Where are you broadcasting from today?
I am in rainy and wet California in Orange County, Laguna Niguel.
Laguna Niguel, know it well. Okay. Why don't you go ahead and get your PowerPoint up? Upon graduation from the University of Southern California with a BS in Business Administration, Mr. Gebhard acquired his Series 6 and 63 securities licenses as an account executive with a mutual fund and insurance group. He then earned his Series 3 commodities futures license with an option specialty before co-founding AltaVest in 1997. Mr. Gebhard also holds a Series 65 securities license. The AltaVest team created Theta Trader to simplify the trading of complex option spreads. Theta Trader uses a proprietary algorithm to pre-select multi-legged option strategies on stock indexes and automatically manage risk and reward. AltaVest developed the Dragonfly strategy, a unique six-leg option spread for premium collection. Theta Trader also utilizes an integrated trade alert functionality wherein clients only need to touch, accept, or reject on their smart device. When not working, he enjoys spending time with family on adventurous outings, as well as vintage automobiles. He also volunteers as a member of the Dean's Advisory Council for La Sierra University's Parra School of Business, and is an advisory member for the Investment Committee of the SDA Church General Conference. Okay, Eric, I see here AltaVest, how you can automatically trade professional option strategies. You have until 5 minutes before the hour when we hand out our next batch of prizes. I'm going to mute myself and you have the floor.
All right, great. Looks like we're up and running. So yes, indeed, we're going to talk about options trading, how we can collect option premium using automation, some of our proprietary tools, and you're going to really enjoy this. So stick around. We've got a lot to get through. And before we get started, remember we're speculating, and with speculating, there is always risk involved. Whenever there's profit, there's always risk. So do take a moment and look through that risk disclosure, please. I'll be quiet for just a second here. I think the main thing is to realize that when trading, you should be using risk capital, and that past performance is never a guarantee of future results. Great, and a little bit about AltaVest. As John said, we've done some things here in the options and future space for many years. We're a registered introducing brokerage firm since 1997. So we've been doing this quite a while. We've traded tens and tens of, millions of contracts over the years. That's yours truly there in the middle with some colleagues down on the trading floor there with the S&P 500 futures options pit, some of the floor traders that we worked with. Another picture I took, a little blurry, but I still like it. That was in New York. And of course, we're highly regulated. So as a brokerage firm, our operations were audited at least yearly by one or two different entities and regulators. So that is to your advantage. We're registered with the CFTC, a member of the NFA. We're located in California. And I won't get into too much of this. John already mentioned it, but I graduated from USC. Have my Series 3 license. I co-founded AltaVest, have a BS in Business Administration. Series 6 and 63 securities licenses is how I started out in the mutual fund industry and insurance. Then moved into commodities, and also with the Series 65, that's called the Investment Advisor Law exam. So I have that license as well. So with that said, the preliminaries out of the way, this is why we don't day trade. If you want to day trade, that's fine, but that's not what we do. And you can also, of course, incorporate what we're doing into whatever trading and investing you're doing as well. And the reason why is I think for most people, it's a very difficult undertaking. A lot of studies show there's less than a 1% success rate. Here's a Charles Schwab study, 6-year period of time. Active traders substantially underperformed a simple low-cost index. Here's a study out of Taiwan over a 15-year period. Less than 1% of the day traders consistently beat the market, and so on and so forth. And then this was interesting. During the pandemic, remember the meme stock era. So all the money that was made as the market soared, it's all been lost. And that was over almost a year ago. So that day trader army is broke. And this poor guy here, I'm not mocking him at all, but it says here he made $1.5 million day trading during the pandemic boom. And now he's lost it all working at a deli in Las Vegas. So that's out of the Wall Street Journal this last month. So let's avoid that, folks. But there are some barriers. Let's see if you can relate to these. Feel free to, chime in anytime, and I'll probably be able to get to some of your responses later. But which one of these three barriers can you relate to the most? I think there's too much noise in the landscape, too much information, talking heads, pundits, newsletters, emails, text messages, you name it, friends, family, everyone's got something to say. And there's a lot of worthless price predictions. This one cracks me up. So Bitcoin's either going to 250,000 or 5,000 next year. So I thought that was a pretty good representation of the difference in the opinions floating around. I don't think that's helpful at all. Jim Cramer, yes, I'll pick on him a little bit. Obviously, he's a figurehead in the CNBC business landscape. But here he says on January 9, the rally won't last, and January 11, the market could rally. So, I mean, how is that helpful? And of course, he talked about Silicon Valley Bank and last month recommending a buy of their stock at 320, and now we're down to 100. So that didn't work either. But the point is, that's a lot of narratives, a lot of storytelling, and we don't do that at all. And we're going to show you what we think is a better way. So secondly, screen watching, time. Who has all the time in the world to sit in front of a screen? Not many of us have time to do this. We have other things that we're doing during the day. I just pulled this off on just a form or something here. It says I sit full time in front of my computer from the market open until the close, watching every once in a while after market hours. So trading full time. So that's fine if you can do it, but a lot of people would rather be doing this. And here's my favorite. Give me a thumbs up if that might be your favorite when you need some rest. So we don't have time to sit in front of the screens and babysit those trades. And here's the third barrier, maybe probably the biggest, is us. We become our own worst enemy, emotions. So you really need those professional tools to control emotion, professional coaching as well. You want to stay off of this roller coaster of emotions and this cycle of euphoria and despondency and optimism, and you want to stay off that roller coaster. This is a great quote from Ed Sequoia from Market Wizards, great book. It can be expensive trying to convince the markets that you are correct. And I think this is true. 3 common biases when making investment decisions: recency bias, confirmation, and anchoring. And this one image might sum it up quite well. I think every possible bias is reflected in that image right there. We tend to think a lot of things about ourselves when we're doing well, that's for sure. But remember, algos have no emotion and no bias, and they're dominating the landscape. If you didn't realize it, JP Morgan estimates that 90% of US equity trading volume is machine-driven, AI-driven, systematic-driven, whatever you want to call it, algo-driven. So how can we use algos for trading professional style option strategies? Well, yes, we can, and that's what we're going to talk about here. So we're going to look at trading spreads and selling options, same types of strategies that really the more sophisticated traders are using and utilizing. And here's a great comment here from this woman on a CNBC, CNBC tutorial, I think it was. I think I have a link in here later on, but it says an option spread calls for buying and selling different contracts, common way for investors to hedge risk and volatility. It's usually cheaper because you can offset your cost by the proceeds from different contracts. So she's absolutely correct. It's been used by Wall Street professionals for decades. And this is interesting. In 2021, 11% of Robinhood's active users made options trades, but of that 11%, fewer than 1% actually made a multi-leg options trade, meaning a spread. So we're going to look at these multi-leg option strategies and how to collect premium. So how would you do it? For example, if you were or how do insurance companies operate? Well, let's look at that as an example. Maybe we can reflect on what they're doing and use that with our options trading. So they get paid premiums to assume risk. They're selling and managing time along the way. They insure themselves with hedging, and they're consistent and they're patient. And they have a process. I should really underline that word, process. I think that's really key. And then probabilities, of course. They just look at favorable mathematical probabilities, statistics, actuarials, you name it. They're just crunching numbers and going through the motions and then managing that. So premium collection with option strategies where you look for lots of base hits by selling short options and collecting the premium. Again, consistency, patience. You have to manage risk because there will be losers. And just as importantly, manage reward. You don't want to get greedy. I just heard the end of Tom talking about closing out positions before expiration and taking the profit while you can. And he's absolutely right. And I'm going to show you how we do that. And we're going to use some of the tools in the demo here in just a second. So we're looking for lots of base hits, not swinging for the fences. And then we have short option strategies that can be applied, of course, to non-directional market conditions and bullish and bearish conditions. It doesn't really matter, but we're looking at targeted outcomes that have predetermined risk. So these are called credit spreads, where you collect the premium. And these are always insured or covered positions. So predetermined risk and reward, and they can be non-directional in nature, like I just mentioned. And we're going to do this with stock futures index options, not individual stock options. And we think there's advantages. For one, they're less volatile with an index compared to an individual stock. And then, of course, you can apply a strategy for any direction on an index very, very easily. And you can even use it to hedge your investment portfolio or put on some directional trades as well. And then with an index, you're looking at trading maybe one market. You don't have to track, what is there, almost 7,000 different securities, I believe. So much easier, much convenient. And there's some advantages to these credit spreads with these stock index futures options as well. There's a wide margin of error with some of these strategies we look at, especially on the, we'll look at this as a non-directional strategy called a dragonfly that we develop, but this is kind of what it looks like. You look for your upper boundary on the calls, your lower boundary on the puts, and you look for the market to stay in that middle range there. We're going to jump into that in just a second. And before we do, let's look at the Greeks, just two of them. We're not going to get real deep into the weeds here, but delta, it's how much did the option value change with a change in the underlying asset. So it's also the approximate probability of expiring in the money. And that's the way we look at it. And I'll show you how we do that in ThetaTrader. So as an example, if delta is 0.25, that means there's a 75% chance that the option would expire worthless. And remember, delta is always moving with price and time. It's not static. And it is not the probability of a winning trade. So I want to make that clear as well. That's very important. And then there's theta, that's representing time when you talk about options, sensitivity to time, time decay. Every option is limited life. It's a wasting asset or a decaying asset, as they call it, limited lifespan. So theta is a negative number. It equals 1 day of time decay. For example, if your option's at 10 points and theta is negative 0.05, then the next day, the premium would be 9.95, and the next day after that, 9.90. That's just assuming we're only looking at theta and not any price movement, of course. So this is what it looks like here with a graph. Simply put, as you approach time zero, the percent of that premium drops and drops and drops and drops, and eventually it expires and that option dies. It loses all of its time. So a deeper look at these professional multi-leg option strategies, how we can collect option premium with some of these unique strategies, even non-directional strategies. But first, just one of the basics. How about selling a call spread? You sell this 45.50 call, you collect 4.5 points, and that's the red line. And simultaneously, you buy a 45.70 call, that's the blue line, and you pay out 2.25. But the net result is you collect 2.25 points, or that means $112.50 on the E-mini S&P 500 in this example, minus any commissions and fees. And so you look for the market to essentially stay below this threshold, generally speaking. And the same with the put, just the inverse. You're selling this put spread below the market, you collect a net premium, and you're looking for the market to stay essentially above this lower boundary here. Remember, these are not naked options. Every position is insured or covered where your maximum risk is capped. and known in advance. These are called covered spreads. So no naked options, no naked trading. Some advantages to that with selling only covered option spreads. There's, of course, you limit your risk and there's no margin calls. That's a big thing that people always tend to forget about. If you're doing naked options trading, at some point it's going to blow up in a big way and you're going to end up on margin call. You're going to have to either close a position out and be forced at a loss to close it out, or you're going to have to send more money, probably sending good money after bad. And inserting a little humor here, this poor woman gets a text message that this trader here is on margin call. So she wants to know who margin is and why does she keep calling you. So avoid that at all costs. Okay, how about an iron condor? It's a non-directional strategy. It's a put spread and call spread combined simultaneously, just like we looked at those two puts and calls earlier. Here's a call spread above the market, a put spread below the market. You sell the call spread, sell the put spread, collect that net premium, and you're looking for the market to stay in this range in between those two boundaries. Now here's our proprietary strategy. Some people have said, well, that's really weird, which is sort of a compliment. So it's called a dragonfly. We came up with this years ago. It's 6 legs to collect premium. It's a non-directional variation on a condor. And this will all make a lot of sense when I show you the demo. But let me break it down for you. Here's the structure of a dragonfly. You sell 4 calls, you buy 3 further out of the money calls, and 1 closer to the money call. And then the same structure with the puts, selling 4 puts, buying 3 further out of the money, and then buying 1 closer to the money. And you'll notice the ones that you buy are, in this case, 50 points closer to the money compared to the 4 that you've sold. And the one that you buy here is also 50 points closer to the money compared to the 4 puts that you sold. And that changes the whole risk reward paradigm dramatically. And I'll show you that. But here's the question. How would you even know what spreads to build, what strikes to choose to buy and sell, what strategy to apply, at what price, how, you know, your entry timing, how do you manage the risk and the profits? Well, that's called theta trader. These are pre-built option spreads. Our proprietary algo will create these theta trades on a daily basis. We talked about professional option strategies, and you can use strategies for any market condition. And then we use automation to actually monitor and track for risk and profit tracking, something called the RTI, or the risk thermal indicator. So with that said, I am going to switch screens here and jump into the demo. Got several monitors going, so there's a lot to follow on these webinars when you've got multiple screens going and so forth. But here is the theta trader demo, and if you should be seeing that, and if not, someone will let me know. But okay, so here we have, this is a demo account here. Here you have the theta trade section here, and you have your open positions, any open short positions, I should say, short spreads or short options, and any long or bought positions here. You'll see your account info here. It's all pulled directly from your AltaVest trading account, and then your current price quotes here. And you'll notice there are bullish strategies that are pre-populated, bearish and non-directional or neutral. And I'll also point out the markets that we're trading, the E-mini S&P 500, which is the ES, and the NASDAQ 100, and the Russell 2000. So those are the primary indexes that we're focused on. And we'll show you why in just a moment, but quite frankly, that's really a function of liquidity. That's where all the action is. So that's where we want to trade. A lot of benefits to that. And we looked at the condor and the dragonfly. So let's just look at those here for today. So here are the condors for today. These are the theta trades that the algorithm has pre-selected for us and built out for us. You can see anywhere from 16 to 65 days till expiration. These trades are available. The strike prices are all pre-selected. This is your maximum profit potential at expiration. This would be your targeted annualized return at expiration. And remember this here, I should say not remember, but I should just point out that this number here, you cannot expect to generate a 293% return just by simply placing this trade. That's not what that means. It's simply here to compare this one trade to all the others and vice versa. So that's why it is there. But I like to go ahead and just pick the one with the most days till expiration for the sake of the demo. Okay, and the first thing I like to do before I dive into the details is look at a graph. So here's the current price, here's the call spread you're selling above the market, and the put spread that you're selling below the market. So that gives you a little overview of how that looks like from, the helicopter view. Now you'll see the days till expiration, the expiration date, quote, settlement value 2.5, the premium, the put risk, call risk, commission, available capital, cash required, your profit potential, targeted return on cash. And let me explain something here. You can see the puts, the calls, the ones you buy and sell, they're all pre-selected, but you could change them if you wanted to, just so you know, but that sort of defeats the purpose of letting the algo do the work. But let me point out something here. You're selling this 33.30 put. It has a delta of 9.92%. So that means there's over a 90% probability that this option, this strike price, would expire out of the money. And look at the call we're selling, the 43.50, 6.96 delta. So you're looking just over 93% probability that this particular option will expire out of the money. So those are the higher probability outcomes we like to use and turn those upside down and turn those into a favorable position for us rather than trying to buy something with low probability. Why don't we flip it upside down and sell these options that have a high probability of expiring out of the money and collect the premium. So you can also see here that the cash required is 896 and your potential profit maximum is 104. And so people say, well, I'm risking a lot more than what my maximum potential is. And yes, that's true. But again, you're looking at the deltas and the probability of profit on those, theoretically speaking, is much, much higher because we're selling these options that are so deep out of the money. Now, it always defaults to a sell when you're selling the condors. And you can do a quantity of 2 or 3 or 4 or 5 and watch all the numbers change here. So for the sake of this, I don't know, let's just do 4. We'll just leave the number at 2.5. We'll try to collect 2.5 points on each spread. And I'll also point out that everything is net of all commissions and fees. So all the percentages and dollar figures in Theta Trader. Let me point that out as well. And we'll go ahead and place that order and show you how simple it is to place the trade. And it just assumes we're filled in the demo here. All right, so I'll go back to the dashboard and let me show you a dragonfly. And then I'm going to show you how to manage it. In fact, it's really hands-free. That's the beauty of it. Not only can we use the algo to help us build those trades and place the trades, but we can use the algo to manage the trades for us. Okay, here is a dragonfly, the theta trades available today for the dragonfly strategy. We'll go ahead and pick this one here. And we'll look at the chart. So you can see the structure of the dragonfly we talked about earlier. Here's the upper boundary, the lower boundary. The red lines are the calls you're selling and the puts you're selling. The blue lines are the options that you're buying to keep that trade covered, so to speak, so you don't have unlimited risk. And now you'll notice here the cash required on a dragonfly is $4,634 on this example, which is nearly 4 to 5 times greater than the condor we trade. And that's simply because you're always selling 4 puts and 4 calls when you do a dragonfly. And if you were to do 2 dragonflies, then that would be 8 puts and 8 calls. And if it'd be 3 dragonflies, then you'd be selling 4 puts and 4 calls. I'm sorry, 12. I'm sorry. So you get the idea. So it's always a minimum of 4. That ratio is always going to be the same. It's going to be 4, or 8, or 12, or 16. So if we did a quantity of 2, you can see the cash required goes up to $9,200. profit potential 732, targeted return on cash, targeted annualized return. And these targeted annualized returns and return on cash will always be a little bit less than a condor. And that's simply because with the dragonfly, remember, you are paying money to buy some additional protection, so to speak, or additional insurance. You buy this option here and this option here, and that costs money. So you're essentially insuring that position against a little bit of some more additional risk, and you pay for that. So we'll try to sell these two dragonflies at a price of 9. And again, let me point out here, the strikes in this particular example, the put has a 9.83 delta, the call has a 6.78 delta. So those are both over 93% probability that these puts and calls being sold on this dragonfly would expire out of the money. And we'll go ahead and place that order. You can see there, it just assumes we're filled for the sake of the demo. And then you go back to the dashboard and you'll see it listed there under the open positions. Okay, and I'll explain these colors in just a second, by the way, but here's the dragonfly we just placed right here. Yeah, right here and here. So with that said, let me show you a really, really great feature. We do some back testing. We have a trade simulator where you can go backwards in time. And I'm going to show you how to compare the dragonfly and the condor. And let me squeeze the screen down just a second so you can see the whole thing. So here is a condor in the month February expiration from January 3rd of this year. And we'll use this button and we'll start playing it here. So we're just going backwards in time and looking at a condor trade. So you can see the market's moving higher, getting closer to the upper boundary of the condor. The trade is turning a little negative. Our P&L is a little bit negative now, but the RTI colors, the green is good, do nothing. Yellow means slightly elevated risk, but still do nothing. So we'll just sit on that. And then it turns blue. And what does blue mean? Blue means take profits. You want to close that position out, take your money and run. The algorithm says that's enough profit and take the win and move on. So this is kind of a typical condor. Now, the key thing here, and I'll show you how to do it, but this can be automated so that whenever it turns blue, when you have a profit-taking signal, you do not have to be screen watching and babysitting your screen. The Theta Trader system will automatically place the order for you to close out that trade for you. And I'll show you how to set that up, just a couple clicks of the mouse. So this is kind of a typical condor, a winning trade. You can just see the market kind of bounced around in that range, and theta decay worked over time. And that was that. So here's a dragonfly on the same day, same expiration. And these buttons, you can go day by day in advance. You can go backwards in time. You can go all the way to the end. It's kind of fun just to play them for the sake of the demo here. And again, you can see the RTI is green. It's all good. Yellow, still do nothing. The trade's turning a little negative. It was profitable. And then it turns blue. Take your profits and run. So it turned blue on February 14th with 15 days. And this one turned blue on February 16. So that's another key point. I'm going to show you another example of that, but the dragonfly will sometimes mature much more quickly than a condor and generate a profit-taking signal, allowing you to move your money out of the trade and into something else. And that's the benefit of the structure where you actually own this call and own this put. In this case, that are 50 points closer to the money. And the algorithm will sometimes be 60 points, might be 40 points closer. It just depends. In this case, it was 50. So here's another example of a trade. I kind of forget what I've loaded here, so let's just have fun with it. Here's another condor. It's a very useful tool. You can go back test. So here's a condor, and it matured with 29 days till expiration on April 1st. So had you done a dragonfly instead on that same day for the same expiration, let's see what the difference is here. Oh, look at that. You had a profit-taking signal on March 21st. What is that, 7-8 days earlier? So again, sometimes the dragonfly can mature much more rapidly, and you can be in that trade for a very short period of time and then close it out and then move on. Now we'll look at a end of month condor here. This is placed on November 20. And again, I kind of forgot what this is going to do. So you see the yellow, slightly elevated risk, and you can see why. It's getting closer to that upper boundary. And then look at this, it turns orange, more risk, but still do nothing, and then it turns red. And that means too much risk, take your loss and move on. So this trade here, according to the RTI, would be a losing trade. And I want to point out something again, just like with the blue trade, when it turns profitable and the order can automatically be triggered, when it turns red for too much risk, take your loss and move on, that can also be automated. So profit management and risk management can be automated with ThetaTrader. And you can see why ThetaTrader triggered that. Just getting too close, even though maybe you could have hung on and who knows, it came back, you know, it doesn't matter, that's hindsight. You have to cover that risk. So here's another trade. And now this is the dragonfly compared to that condor. And look at this here. The dragonfly actually took profits instead of ending up with a loss. So again, you see how, in this case, the 32.90 call here, you probably can't see it, but is 40 points closer to the money compared to the 4 you sold. So that made a huge difference in the dynamics of this trade. So this dragonfly actually became profitable compared to the same trade, or I should say the same expiration and the same trade being placed with a condor structure. So you can see the benefits of the dragonfly. So not only can you get an earlier exit, but sometimes you can have a trade that would have been a loss with a condor actually be a winner with a dragonfly. So here's another condor. You can see the yellow and the orange, and then wanted to point out that I'm not going to just cherry pick and show you all winners. So yes, there's some times where you're going to end up with a losing trade no matter what you do. So here's a losing trade. Here's a condor. Ended up losing money, and maybe if you held on long enough, it would have come around, but I wouldn't want to risk it. So that is how it works with a condor. You end up with a loss, and that's just the way it goes. Now, I want to point out something here. Up in your menu, you'll see you have trade scope, daily summary, you have account settings and help files, video tutorials, education, and so on and so forth. So here is the daily commentary that we write. It's our daily research, and we push that out and publish that for our clients. Here's our daily trade scope. It's more of a technical newsletter that's done every day. Here you can see an overview of the key markets we're looking at, and then looking at some forward guidance and so forth. So this is all part of ThetaTrader. Some of the rate hike expectations here. And here's the daily trading commentary. People like reading this. It's short and sweet, to the point. What happened in Europe and Asia and the US, what to look for, looking ahead, some of the key zones on the charts, any trades that were filled. And here's the real trick. Let me show you how to do it. You go to my account, you go to settings right here. And if you want to activate your risk manager, you just check that box. So that way, if any trade turns red, too much risk, get out, take your loss and move on. Your orders will automatically be placed for you. And if any trade turns blue, you can activate that profit directive and then save your settings. And that's all you have to do. It's that simple. And there's also, under the My Account here, there's a great help file. And also I mentioned videos and tutorials, but you can see the color coding. It's all explained here. I won't go into all the details. but how it works and when the color codes are triggered. And that's all explained right here in the help file. Now, let me go back here and let me show you. You can also look at your open positions all on one page here. I know there's a lot to get through and I'm probably talking your ear off, but apologize for that. And I'm going to show you the best feature of all in just a second, but here's what it looks like if you want to look at all your open positions on one page. And here they are. And you can see out of 11 positions, 9 are short spreads, 2 are long spreads. You can see the color coding right here. And it's not uncommon if you buy spreads to see that those are going to be tending to lose more. Those are going to lose more often than selling spreads. It's just the way it works. So that's why we like to focus on capturing premium and collecting premium. That's more of the bread and butter of what we do, but it's not primarily or only what we do, I should say. And then here are your closed positions. This gives you an idea of how your account might be performing. So you can see here a total of 20 trades, 16 winners, 4 losers for the total P&L there. 13 were short positions. So of those 13, only 1 was a loser. So that makes sense. We talked about those higher probability outcomes. And then this also makes sense. You had 7 long positions, 4 were profitable and 3 were not. And that also sort of makes sense as to what we're talking about. It's just math. You do this long enough and your short option spreads are going to be more profitable more often, or I should say be more often profitable compared to your long option spreads. Let me point out one other strategy because there's more we could get into, but let me just point out a couple other things real quickly because all we did is look at the condors and the dragonflies, which are more of a non-directional or neutral strategy. They have a little bit of a skew depending on what the algo chooses, but not much. But again, you can do bullish strategies, bearish strategies. You can choose a different market, the Russell or NASDAQ. And there's something called a bear hedge that we kind of came up with this name, also a bull hedge. But in the case of a bear hedge, let me just point out what it is. Here, we'll just pick this one. The April week 2 expiration has 30 days on it. Let's see. Oh, it looks like I chose the Russell. Didn't even mean to, but that's okay. So the bear hedge is simply, here's the current market price. You sell an out of the money call spread, in this case right here, and you collect premium when you sell that call spread, of course, but then you use that premium to buy an out of the money put spread to finance the purchase of that out of the money put spread. And normally you can do this for even money or even a credit. And so this would work well, of course, if the market continued to drop like a rock, just like the Russell's been doing here for the last month, because the put spread you buy would hopefully make money and not lose too much time value in the meantime. And the call spread you sold would be also making money. So you could certainly do that type of strategy. Maybe we'll just go ahead and place 3 of these. And again, you can set up the account so that ThetaTrader monitors that position. It will track it and then close it out for you automatically when it reaches those risk and or profit targets, whichever comes first. And I should also make it clear with what we just showed you and what I just showed you here, if you're doing these condors and dragonflies and these short option strategies, ThetaTrader will always have you out of the position before expiration if you choose to automate it with the RTI. So we don't ever suggest hanging on to any of these short option positions to expiration. Oftentimes you're gonna get out of that position with maybe half of the time remaining. So I just want to point that out. But there's a lot of flexibility, whether you're bullish on the market, whether you're bearish, maybe you're in between. You can do anything you want with ThetaTrader. It's a very flexible tool. You saw the trade simulator, how that worked. You can use that for your back testing, so it's a lot of fun to use. But let me shift gears and show you the best feature of all, I think, for Theta Trader. Okay, so can you make it easier? Yes. How about the trade alerts? These are 1-minute trade alerts, one-touch responsive alerts. You simply touch accept or reject, and that's all you have to do. And let me show you how that works and why it works the way it does, because our technology has built this out so that the alerts are integrated with your AltaVest trading account. If you want to accept an order that you receive on an alert, comes to your smart device or email or both, you just simply touch it and accept it or reject it. So let's take a look. You'll get a text message with a link. You'll touch that link. I'll just pause it there. You can see a little description of the trade. It's a few years old, but it all works the same. Although there's a few additional features. I just like showing you this because I zoomed in so well on this. You can see it. You can see here it's pre-sized. The quantity in this case, selling 10 of these October condors here at a price of $265. So every trade alert you receive is tailored for you and your account size. And it's also not going to be redundant. You're not going to have the same strikes as current positions or the same expirations. They're always going to be laddered and diversified among strikes and expirations. You can see you're collecting this amount of premium. Here's your cash required. Has 71 days, your targeted annualized return. Look at that, S&P was down near 2,900 at the time. Anyway, and then you just simply touch accept. And that's all you have to do for your trade alert. How cool is that? Let me do it one more time. The idea that you get trade alerts now with an email and you have to then log into your computer and copy a trade alert and try to buy or sell something. And, it's just very clunky. And it's a ripe environment for errors too. People call me and they'll say, oh, I just did a buy sell error. I had a service I subscribed to, some sort of newsletter, trade alert service, and they took a trade alert and they did it wrong. So anyway, now people say, well, that's great. In fact, our clients love them. But this is what we've done. We set up a proprietary account. This is real money performance. This is our year-to-date trade alert performance. We just set this up January 1st. So take a look here, and before I show you the results. Basically, this includes all the trade alerts that we've sent from the beginning of the year. And essentially it says past performance is no guarantee of future results. So here's a summary of the closed positions. This is our real money account. We have 18 alerts total. You can see the profit and loss here. Short positions and bought positions. You can see again, the majority of the sold positions are winners. The bought positions, 2 of the 5 were winners. So that is the net result, starting with 25,000. So that is the total profit and loss, but almost $2,200. So closing in on a 10% year-to-date gain with those trade alerts. And here's what it looks like with our open positions at the moment. We have a couple short call spreads on board right now. You can see the different strikes, the 41.80s and then the 42.20s. And you can see here the market value. We started at, like I said, at 25,000, so 27,212. And so that's gives you some idea of how many alerts to expect, by the way. So you might expect maybe 2 a week. I'm just gonna kind of throw it out there, maybe 2 a week, maybe 3, maybe 1. And you're probably gonna be mostly selling option spreads, whether it's condors, dragonflies, or just outright put or call spreads. Sometimes we've done butterflies too, or even buy some positions, put or call spreads. But mostly we're going to be short premium. And we went bearish last year in January. So last year, clients did very well following our trade alerts. because they were mostly bearish strategies with few exception. I think we had 2 or 3 dragonflies throughout the year that actually worked out well. So here's how to get started with us. Get a Theta Trader membership and what it includes. So the Theta Trader software with everything you saw, the Theta Trades, the RTI and the simulator, $3,588 value for that software. And then of course the one-touch trade alerts that we just saw, those are invaluable. $4,400 value on those trade alerts. So you get everything with your Theta Trader membership, the software and the alerts over an $8,000 value. And then here's the thing that really makes it more than worthwhile is you get private training and a private coach and someone who's experienced and licensed to work with you. And we'll just kind of develop that relationship with you and take it in any direction you want. Some people want a lot of attention, and that's great. And others don't say, well, I've got it all figured out, and that's great too. But you work with us, $7,500 value for that co-pilot and that coach. So again, Theta Trader software, the alerts, the coaching, $15,500 value. And remember, I pointed out the research we have, that's our trade scope and our daily commentary. That's all proprietary in-house. People love using that. $2,952 value. We do have online video tutorials within Theta Trader as well. That's just part of Theta Trader. So just to summarize everything you get, an $18,500 value for your Theta Trader membership. But of course, that's not what we're offering this membership for today. We used to offer this at $4,000 at live in-person events, then people would sign up in the back of the room. But we love these live presentations, especially the Mad Hedge event. And so we're going to do even better, 85% discount for the Mad Hedge special lifetime membership, one payment of only $597. And here's the link, cf.altivest.com/mad. And you can take a screenshot of this page and take a picture of it. And that's my direct phone number there. If you had any other questions, I'm available. Not this second, of course, because we are live. But yeah, and now 30-day money back guarantee on that. So really, it's no one's twisting your arm or anything. If you don't think it's going to work for you, that's fine. We just refund the membership. And this is what the order form looks like. Real simple. You see the special MAD offer. You just fill out the order form there, one page, and click here, and that's it. Then you're a member. It's just that simple, folks. So we'd love to have you. I think you'd love using it. It's a very flexible platform. A few FAQs, if you didn't know, futures and options are tax efficient. I won't go into all the math, but if you're trading individual stocks, and in this example, you end up with a 12.6% return. But if you're trading with us with the same math, you have a 14.64% return just because of the tax efficiency, the savings of over $2,000. No more itemizing as well, no more wash sales or anything like that. Always consult your tax attorney or advisor. And we mentioned why the E-minis, well, they're liquid, they're cost efficient, and well, they're cost effective and efficient. The E-mini S&P 500, look at this here. It outtrades all ETFs around the world by over 2.5 times. And in relation to the SPY, it's 10 times greater in terms of the average daily dollar volume. So more advantages on the E-mini options. And I know I have a little bit of time left, so I'll just kind of go through this quickly. Volume, liquidity, access, superior execution. That's the whole idea, folks. You want to be in these E-minis. That's what's that's why there's so much volume in here, because you know, the execution savings. There's so much liquidity. Your spreads are very, very tight. And that's why we're in it. Largest market share. You have all the strike prices and expirations you need. They call granularity. So you can find the Theta Trader will find the strikes that it needs. And here's one big advantage with Theta Trader on the E-minis. When you do a dragonfly, it's one order placed as one trade at one price. There's no legging in. So you do those 6 legs, those 6 different strike prices at one order, just like you saw how easy it was in Theta Trader. But if you're doing stocks and you try to do a dragonfly, you can't do it as one order. You have to break it up into 2 separate orders. And now here, retail stock options traders, they have access to the most basic call and put option strategies only. They don't have access to option spreads or other more sophisticated strategies. So unless you have like, different like level 3 and 4 and whatever, you have to apply for access to these more sophisticated strategies. But of course, with DataTrader and us, you immediately have access to sophisticated option strategies. Remember, professionals are not just buying options. If you only buy options, time is working against you. It says retail investors buy options because they're cheaper and the potential for profit is actually not that high. And she's absolutely right. So the advantages, again, we're tracking just the indexes, efficient margin versus stocks, clear cost structure. Remember, these are E-mini options at the Globex exchange at the CME group, futures exchange. Every order is treated equally. There's no payment for order flow. I won't get into all the nitty gritty, but basically the payment for order flow just means when you're placing an order with something like Robinhood, your order is not being filled by Robinhood. It says here, they pay brokers, these third-party market makers like Citadel, they pay brokers like Robinhood to send customer trades to Citadel to execute. And so what happened to Citadel? Their market making division generated $7.5 billion in profit, its best year ever. So that's where your spread is going. It's going somewhere else. So if you want a broker to work for you, just pay a commission, according to David Einhorn. Nothing of value is truly ever free. That's probably a great statement to file away. But yeah, no payment for order flow with us. Our rates are 5.25 round turn all in. It's actually very competitive and cheaper than some of the big box brokerage firms trading futures options. And again, everything is net of all trading costs, and everyone's going to be performing a little differently, of course, depending on what trades they accept. We're not managing the accounts for you. $25,000 is our suggested minimum. If you want a free account, free membership, $100,000, we'll rebate that for you. Gladly, no trouble there. 50,000, we'll rebate half of the amount for you. Of course, IRA, you can do those IRAs, individual, joint, all the above. And just to kind of wrap it up, why would you even consider something like alternatives in your portfolio? Well, it helps may improve diversification and lower portfolio risk. There's always risk of inflation. Long-term inflation is equal to 4 to 5% each year. I think he's absolutely right. Everything doubles in price 14 to 15 years. What about a dovish Fed pivot? I'm not going to get into all this, but their target's down here at 2%, and they're still up here. So I don't know, even with what's going on, I don't know if that kind of a joke there, pivot way ahead. But let me jump here. I'm going to skip through this here. It's kind of running out of time. I just want to get to just the last segment here. We think DataTrader is your alternative solution, but you should not be passive. You should not always buy the dip. Thought that was a good picture there. But here's the benefits of sidestepping, bear markets and really avoiding drawdowns. That's the whole point of this. Remember, it took 6 years after the tech crash and 5 years after the financial crisis to regain prior highs. Look at these red areas here. If you bought here, it took many years to get back to where you were. You bought here again. If you bought the Dow in 1929, you didn't get back to even until 1954. And in 1966, it was still in the same spot in 1982, this red line here. So remember, avoid these drawdowns. If you're down, it's, something we sometimes forget if you don't stare at this every day. But, if you're down 40% in your account, it's going to take a 67% return to get back to where you were. Stanley Druckenmiller thinks there could be a flat decade for stocks. We should probably pay attention to him. 60-40 portfolio doesn't always work, had its worst return in 100 years last year. So we like the idea of having alternatives as part of your portfolio, and that's what DataTrader does. It's flexible. You can be bullish, bearish, and nimble, non-directional, all the above. And here's kind of to summarize it again. DataTrader, pre-selected spreads, automated trade exits, integrated trade alerts, personal coaching. There's that order form. And 5 simple steps once you become a member will just get you onboarded, is all that's really saying. And there is the last slide. And I think I probably have some comments and so forth, but I also think I'm running out of time. If you're living in a different country, call me or email me, Eric@Altivest, ERIK @altivest.com. And I'll let you know. 25,000 is the minimum account. And we are the brokerage firm. Good question. So you become a member and then you would open an account with AltaVest. And we can definitely help you get up to speed with options. There's training and tutorials in there as well. So you don't have to have a lot of extensive experience. And you'll learn a lot definitely with us, working with your coach and your trainer. And if you'd like to get out of a trade, if someone's asking about legging out, we don't recommend it. We get into the spread and then you get out of the spread as one piece. And important lessons for beginners, position sizing and working in increments. You don't want to ever allocate too much capital at once. Good questions. And we like to trade the E-mini S&P 500. That's probably our biggest market that we trade. So yeah, thanks for all the questions, but I think you'll love it. It's very user-friendly. We designed it this way. We've traded with thousands of clients over the years, doing millions of options, and this is what we came up with to help you out. So that's where we are, and I think I'm running out of time.
All right, Eric. Well, that was great. Always love listening to your presentations. Very sophisticated. I'm sure a lot of people can use this. So thank you very much, and we'd love to have you back.
I'd love to be back. Thanks for having me, and it's always a lot of fun. I love listening to everyone else speak too, so it's
Isn't that
always a lot of
great,
fun.
too?
It
It's
is.
first-class education.
Yes. Thank you.